All right, so the big headlines are the housing market is cooling off 2022. People are still talking about a housing market crash. So what I want to do today is Fortune just released an article late last week that talked about 7 leading forecast models. I want to break all those down. I want your opinions, Mr. Frost, and we'll go through these. So here's what the article said. So let's get into this. All right, so it said already there are signs of the housing boom is losing some steam. We're seeing seasonality, absolutely. A cooling period that happens like clockwork. That's not all. More home buyers are finally beginning to push back against surging prices. Indeed, the October 60.3% of sales involved a bidding war, which was down from an all-time high in April, which was almost 75% of every home sale being in a multiple offer situation. So there's also an increased likelihood that the Fed will raise rates to to bring down inflation. So let's talk about rising mortgage rates, which could potentially slow down the market, but I don't think crash is appropriate.
No, I don't think so at all. And I really don't think it'll come from the interest rate side of things, because we've said this since the beginning, right? Since the pandemic first happened and they're going into these mortgage forbearances, we said in my belief has always been that the housing market, the mortgage world, and putting that cash in people's hand is what's going to pull us through this thing. And it truly has. I mean, that whether it's a construction business, the renovation, like the trades and all those kinds of things, the low interest rates and managing that, like, no, you can't keep rates low forever, right? Rates have to start going up. Otherwise, the feds and the government, they don't have any tools left in their toolbox for the next recession, when or if or how it happens, right? So you're going to start to see some of that rise. And that's going to come from, the Federal Reserve tapering back some of its bond purchases. You'll see them raise the interest rates, the federal funds rate, which is the big number everybody talks about. That's like what did they used to call that what did Hillary Clinton call it? A nothing burger? Like the Federal Reserve is like that, raising that rate 1/4% or 0.5% is really a nothing burger when it comes to actual like long-term interest rates. That's going to be more driven by the bond market, stock market, things like that. So I don't see the mortgage rates like flying off the handle. Yeah, will they go up gradually? Yes, 100%. This happened last time. Yeah. You're still at record low borrowing rates.
Yeah, well, and before we kind of break down some of these models that these large companies are getting into, a new unemployment number just came out, and so it was expected that 500,000 jobs would re-enter the marketplace, but that wasn't the case. So what happened?
So
it's like 200,000 jobs.
It was like 210,000 jobs, which is a government report, right? So that's like the National Labor of Farm, something, I forget the exact term. I don't want to say it the wrong way, but so they reported 210,000 jobs gained, and then they revised the number from last month to an additional 82,000 jobs, which kind of shored that number up and didn't make it look so bad. Yeah. But the big number is that the unemployment rate went from 4.6% to 4.2%, which paints a whole other picture, because like everything, there's a different reporting model and a different reporting system that came out and said, actually, because of that rate, that decreased rate in unemployment, that 1.1 million jobs were created. So there's these two numbers and this giant discrepancy. So really, who knows? Because it goes back to like what businesses were created, which ones left the market, what people were not in the job market that weren't looking for jobs, that don't contribute to the unemployment report because they don't care about employment, so they're not one or the other. So it's kind of a weird thing, but the number that we always look at though was disappointing. It was not exciting for what they were expecting.
Well, let's talk about that. So when we're talking about the Fed most likely raising interest rates in 2022, which we all believe is going to happen. Yeah. But then unemployment, the number of jobs that we thought were going to be created don't happen. That puts the Fed in position to keep rates lower. So that's like the chicken or the egg thing, right? Yeah. So how does that affect? How does this new information affect that potentially?
It's a good question. So when it comes to their decision on whether or not to raise rates, that in the Fed funds rate is what they're referring to. That is 100% driven by inflation, right? So that doesn't,
which is outrageous right now, by the way.
Right. So, and inflation is ultimately driven by wages and the number of people working. You have a lot of people working, a lot of people buying things, and wages are up 5%, right?
Yeah.
So inflation's the hottest reading it's been in 30 years, up 6.2%. Well, wages are up 5%, right?
Yeah.
And we're getting all these people back into the workforce. So that Federal Reserve rate or the Fed funds rate will get raised because it has to combat this inflation. As far as like interest rates for the market and housing and all these things that we're really focused on is going to be the market's interpretation of were there 1.1 million jobs or were there 210,000 jobs, or do we look at how many people filed for unemployment, which was like right in the middle at 500,000. So it's kind of the markets will determine that, but the way everything's looking, we are going to see an increase in rates. Like long-term mortgage rates are going to go up.
Yeah,
it's going to be slow, but they are going to start moving up.
Yeah, so let's talk about the headlines that have been coming out this week, which is like all the talk about prices leveling off, right? That's like the big headlines right now. And what does that mean for the housing market moving forward? So the first index I want to look at, or the first, really the model, was from Zillow and Goldman Sachs. They kind of put this one together. So let's see. So Zillow and Goldman Sachs. Zillow projects home prices will rise again 13.6% between October 21 and October 2022. Meanwhile, Goldman Sachs forecasts another 16% uptick between those same times. Now, what we have to look at is there was a record between August 20 and August 2021, 19.6% in home price appreciation. And so the headlines are saying, hey, things are leveling off. I want to first look at, Steve, is that that is correct. I mean, the last 3 months, we haven't seen the appreciation that we've seen in really the last 5-10 years. However, here's the thing that people have to put into context. Prices now, even if prices stayed where they're at now, they're still at historical highs. I mean, they're way higher than they ever have been before. Yeah. Home prices can't continue to go up by 20% every year.
Yeah. I mean, we went like 0 to 100.
Yeah.
And you can't get to 100 to 200 miles an hour as fast as you go from 0 to 100 miles an hour.
Yeah.
Unless you're in like a crazy, you know what I'm saying? So it is, and again, and I've always said that, like, we're seeing this crazy run up in housing. We call that COVID money or whatever you got, or whatever happened, right? There's this pent up demand. And I think a lot of it comes from like remote employment. I used to use the analogy of like people that grew up in the Depression, like, why is grandma washing the paper plates, Dad?
Right.
They're like, well, because grandma grew up in the Great Depression and they didn't have plates and these things like that. Well, now it's going to be our kids like, why is your dad so weird about his house? Like, oh, well, he was alive during the pandemic when he couldn't leave.
Yeah, that's a good point.
So like, all these people are like, they're all wanting these new homes. So that coupled with the numbers for building and housing starts and new home construction. Yeah. The preceding 10 years was very low.
Yeah.
So we're not building homes. Right now we have this pent up demand for people to move because they went through, they're now the pandemic dads that are moms that are weird about their house. And then you also have a huge generation of millennials that are like, that waited until they could enter this housing market.
Yeah.
And and we couple that with wages and higher level educations and things like that. So now your first time buyer is coming in at possibly $100,000 to $150,000 a year in combined household income.
Yeah.
And with the interest rates, that's a $500,000 home.
Yeah. So that's funny. So the report talks about that. All right. So here's what it says. It says, neither Zillow nor Goldman Sachs foresees the demographic wave of first-time millennial home buyers letting up, which is exactly, I think, what you're saying. So we're in the midst of a 5-year between 2019, 2023, in which the 5 largest millennial birth years between 89 and 1993 are hitting an all-time important first-time home buying age of 30. According to the forecast, there won't be enough homes to satisfy all the demand next year, which is in 2022, which again suggests that we're going to see a good housing market next year, regardless of interest rates, because supply and demand. Would you agree with that?
I do, and I'll admit I didn't even read that paragraph.
Right.
I never read that. Yeah. So, like that's just my thought. So there's, right now we're building homes and we're adding supply, right, to the housing market of like roughly each year 500,000 homes, right? So 500,000 new homes are being built every year, and there's right now a documented 3 to 4 million home shortage to just shore up supply, right? Because that's really what's driving this, right? There's like a supply and demand issue with homes. isn't that how any price goes up, right? When there's not enough of something and more people want it, can afford it and buy it, they'll pay more.
Well, that's exactly what happens.
So that's what's happening.
That's what's happening with everything.
Yeah, exactly. So
cars, watches, everything. We're in a huge shortage of everything.
Right. So, and so the housing market, so you couple all that together and you can't, of course, like I said, it's never going to go from 100 to 200 as fast as it went from 0 to 100, but we're still going to see homes go up in value. There's nothing, even in interest rates, there's no indicator, there's nothing that's going to be so substantial that it's going to take these prices from where they're at now and see them drop.
Right.
You know, that's the thing. The rate at which they go up should slow down. Otherwise, it's going to be like Hong Kong.
Yeah.
You know, it's going to be insane. But we're not going to see that same increase.
Yeah. Well, and to that point, so Redfin and CoreLogic, so when we look at the 7 models, they saw it differently than what Goldman looks at. And so here's what it says. So the good news, the article suggests, is this good news for home buyers looking into next year, right? So it says, among the 7 forecast models Fortune examined, 4 predict we're going to see price growth in 2022 fall back closer to historical averages. So that includes Fannie and Freddie, which are predicting U.S. home prices 7.9 to 7%. That's slightly higher than historical norm. However, it's hardly that the eye-popping numbers we've seen during the pandemic. Meanwhile, models released by Redfin and CoreLogic foresee that home prices are going to go down 3%, 2 to 3% next year. So
to correct that though, that's price growth.
Yeah.
Right. So price growth so Fannie Mae and Freddie Mac and that they see prices growing 7.9 to 7% a year. So on a $200,000 house, that's $14,000 to $16,000 that your home's going to go up in value per year.
Sure.
Right, which is less than 20% that we're seeing now. That would take your $200,000 home to $240,000. And then you look at like Redfin and CoreLogic. So even a 3%, they're saying your $200,000 house, which a year or two ago was maybe your $150,000, $160,000 house, is now a $200,000 home. That may be 3%? So like 207 to 208,000. So you're still seeing a growth.
It's a good point.
And again, the argument that we're making is it's not a crash.
No.
It's just a slow in the growth.
Yeah.
You know? Well,
and now into your world, right? So the Mortgage Banker Association is predicting the median price of existing homes will decrease by 2.5% between the fourth quarter and the first quarter of 2022. So when you look closely at this model, it's easy to see why. So the Mortgage Banker Association took this position. They said forecasting the average 30-year fixed mortgage will hit 4% by the end of 2022, which is what I think you said in our last housing market update. So over the course of 30 years, that's going to add an additional $90,000 in cost to a $500,000 fixed rate mortgage. This is what we were talking about in the last video. As interest rates go up, if prices start to level off, which they absolutely have, which we both think will absolutely happen next year, they can't keep going up by 20%, interest rates go up, it will slow the market. However, there's so much buyer demand and we still have a massive inventory shortage. To give context, right now as we're making this video, we're sitting at 1.2 million homes for sale versus this time last year at 1.4. So we're still down 12%.
Yeah.
So even an increase to 4% interest rates, it just slows things down, but there's no area of concern.
Right. And something to think about too is that, so they're saying over the course of 30 years on a $500,000 fixed rate mortgage, which is higher than the average mortgage in America.
Which is $380.
Right. So if you think about it, on a $500,000 mortgage, if rates are 3% today and they're 4% at the end of 2022, that's $416 a month in interest more that you're paying. So am I saying that's nothing? No, absolutely not. I mean, $400 is
$400.
It's a lot of money, right?
Yeah.
It's a car payment or whatever it might be. But at the same time, it's not thousands of dollars a month either. A lot of people, if they look at a house and see, a $400,000 to $500,000 home, right? And they compare those two, the $500,000 home being $416 more per month. They're going to, most of the buyers that are in that $400,000 range are going to buy the $500,000 home. Even with that $416 difference. Yeah. That's not going to stop them in that price range. People say, what about the lower numbers? Well, it goes the same way it's $180 a month different on a $200,000 loan. Yeah. You know what I mean? And those people, you'll find a way to make that work if you love the home. So the interest rates will definitely slow people down. But if you're approved at a $550,000 purchase price and there's a bidding war and you go up to 575, that 25 grand is going to cost you like $40 a month. Those people are going to buy that house.
Yeah.
You know, so
That's a good point.
I don't see it having that. You have to break it down. You know, $90,000 is a lot of money over 30 years, but is it? Like
Right.
the $90,000 is a lot, but I think 30 years is way bigger of a deal than $90,000 in 30 years.
Yeah,
You know?
that's a good point. Well, and the NBA actually they agree with you because they said in the article, they said even the NBA, when they talk about the price drop, it's hardly a housing crash. I mean, that's what they said in the article. So it'll be interesting to see what happens. I think that we're all on the same page when it comes to looking into 2022. And my housing market prediction of 2022 is that things slow down a bit.
Yeah.
Housing prices do level off. Interest rates will go up. There'll probably be less competition from a buyer's perspective. However, money will be more expensive, but home prices may not be, as high. So nowhere near a housing crash in my perspective that I can see. None of the data suggests that. What are your thoughts?
I agree with that 100%. And something we didn't touch on that the big winner, the biggest winner of this appreciation, this 19.6 from last August, is the person that anybody that bought a home in August of 2020 that is now up 20% in value. Because that person that put 3% down or 5% down or whatever it is, their lender won't take them out of PMI, but if they contact their lender, they contact their person, you're getting rid of PMI.
Yeah.
Which is amazing. I mean, that's the biggest thing. I mean, you want to talk about rates going up, whatever it might be. There is opportunity now where people can lower their payments. So there's a lot of different things. It's the housing, the buyer and seller's market matters, but there's also a lot of things you can do to provide or improve your financial health based on decisions that you made a year ago based on these housing number values. So that's just the one point I wanted to make, and that's because I'm a loan guy.
Yeah.
So I'm always thinking like, how can you save money, and like how does the pricing impact the value of your house and that kind of thing. So that's just that piece. But like you said, and we've had the same thing. You know, we've talked about it for almost 2 years now. Is that the housing market's going to continue, and it always has led the recession. It's always been or lead the economy, and it's always been a leading indicator of the health of the economy. The health of the housing market will continue to help the rest of the country grow. And we are absolutely going to see home prices level off. We saw that coming, but where we're at now is amazing. I mean, these highs are crazy. And hopefully it does. Hopefully it takes a lot of the buyers that dealt with the bidding wars in 2021. Hopefully that some of this news and some of these changes loosen some of that up and get them back in the market and give them some opportunities to find something.
Yeah, you're right. I mean, I think the other thing that we do have to keep our eye on in 2022, there was a new report that on mortgage applications and the rise of cash out refinances.
Yep.
So because of the appreciation of home prices, people's equity positions have been very stronger than they probably ever have been in U.S. economy's history.
Yep.
The thing that we have to pay attention to is, and this will be a counter argument to our position for the last 2 years, is, and we'll pull up that report on maybe the next update, but the NBA came out with a mortgage application stat, and they said there's a huge influx of cash out refinances that are happening, which is decreasing people's equity positions. So if home prices, if they do go down in the future and people are taking equity out of their property, it could change the entire landscape. Because if we find ourselves in a situation where interest rates are going up and people find themselves in a position they found themselves where they owe maybe as much as their home is worth, that could alter the trajectory of a potential housing market crisis like we saw in 2008. So we have to look at these cash out refinances and then property values to compound coming down. Do you want to share any thoughts on that?
Yeah, so I disagree. And the reason is, in my experience from in 2008-9, is that the reason we had such a crazy foreclosure crisis, especially because people are doing the same thing, right? Property values were going up like crazy. People are taking tons of equity out of their home. But the difference today is lending standards are far more strict. People's mortgage payments aren't changing. So as long as if your employment and your household income doesn't change, your mortgage payment's not going to change because most of these loans that we're doing today are locked because 30-year loans are so low. Like
Yeah.
a 30-year fixed is the same pricing or sometimes better than a variable rate. So that number is going to remain static where we didn't have that before. So ideally, everybody keeps their jobs and everybody's able to make their payment. But it is something to think about.
Yeah.
The thing you have to think about is that using the equity in your home to improve your home, using the equity in your home to maybe pay for college or doing some things like
Debt
that.
consolidation.
Stuff like that is one thing. But the one thing you can't go back to is your home being a debit card. You can't run up a bunch of credit card bills and think, oh, I'm just going to refi again. I'm going to refi again. That mindset is the wrong way to go. And that's definitely can be a concern. But continuing to use it to improve your property or making good decisions with it, I still think we're going to be okay. I don't think that's gonna be what
you're giving a lot of credit to people making good financial decisions.
Yeah, I know.
Humans don't make good financial decisions. They're using their house as a credit card. Here's what's happening. People are cashing out on this huge rise of price increases and buying a car.
Yeah.
They're buying a boat. They're buying a second house. And so I tend to agree with you. I think the thing that we have to look at is, if I drew this out for the audience, is if your equity position's shrinking and the value of your home is going down and you lose your job, this year you could have just refinanced to save money, lower your interest rate. But if interest rates are higher than your interest rate is now, you owe what your house is worth, you lose your job, and you use the equity to buy a second property, your debt is increasing.
Right.
So that's the thing.
Yeah, I mean, you do. You have to have that piece. Yeah. So if you're financially responsible,
which people are not.
Equity. Yeah, right.
You're giving a huge assumption that people are.
For sure.
I would venture to say that most people are making the wrong decision financially.
Yeah. Could be.
And so it'll just be something for us to report on next year.
Yeah.
These equity positions are not going to be as sexy as they are now.
Yeah.
People are grabbing the cash.
I'm also surprised you're so negative.
Well, listen, I tend to agree with you.
I get it. Yeah,
there's just another perspective.
Definitely something to watch for sure.
And so that's all we need to keep our eye on. So that's it for this market update. We'll see you guys in another one. We appreciate you guys' support. We appreciate you guys watching the show, and we'll see you guys soon.